All right, welcome. Welcome to Random Walk Trading's Options Professional, Lesson 11. I'm Alex Mendoza, and we've come to the point where we're starting to put all these things together. So for a lot of you, what you'll find is when we start looking at sessions and how to approach them, you'll start to see that a lot of the things that you've been doing and a lot of the drills that we've been handing you out as homework and as review and the things that we've been doing in the book, in the DVDs, and in the handouts, and in the homework, and in the webinars, all of these things have started to really allow you to look at a position in a very different way. And so, therefore, a lot of what you see is now going to just basically allow you to see positions in a different light. And it's going to allow you to really appreciate all these things that we're able to do in order to that are going to help you put positions together and manage them. So with that said, what we're going to do is we're going to basically walk through a position on any given day. And what a lot of people don't realize is traders, there are some really talented people out in this world, and there are people that can make some really good decisions very quickly. And we're not going to assume that any of us are those people. We're going to do things the way that everyone who aspires to become a professional and who has been a professional, and anyone who doesn't have any God-given talent, is able to go out and really trade and manage positions successfully. And a lot of that, more than anything else, has to do with the preparation. What are the things that you do in the morning? What are the things that you do in the evening, such that your decisions, as you start to decide how you're going to walk through a position, what are the things that you prepare for so that you can anticipate the things that are going to happen to you during a trading day? And I know that we have a lot of students that unfortunately cannot stay awake during market hours. And this is something that when I was doing a seminar in Australia, the Essential Seminar in Australia, I actually went ahead and addressed the students, and I said, I understand that the U.S. markets are open while everybody's asleep, and for the most part, it's okay. But once you get down to expiration week, that expiration Thursday and Friday, every once in a while, your positions are going to demand that you stay awake. And the way we looked at it was, there's always a certain amount of money that I can pay you to stay up all night. And the idea there was that if you have a position in which there's a lot of money at stake, then it may require you every once in a while, around expiry week, to stay up all night and to be able to manage these positions. It doesn't happen that often, but it happens often enough that you want to make sure that you consider that. So what we're going to do still is to first review the procedures that traders should consider implementing should consider implementing into their trading day prior to making their trading decisions. What are some of the things that you want to look at? And there's a lot of misconception out there about things that traders look at, things that they don't look at. What do traders really do in the morning? And if you've been trading for a while, it's really interesting. If you're any kind of a professional, I'll tell you something. You probably don't dwell on your charts, even if you use them. And I can tell you from my floor trading days, I did not use charts. But that doesn't mean that other people do not use charts. Unless you're trading minute-by-minute charts, chances are the chart you looked at yesterday looks pretty much the same as it does today, and so on down the line. So if you've been looking and been mildly observant of your charts, chances are they look the same today as they did yesterday and the same as they did the day before, and therefore, it's something that you want to make sure that you don't dwell on too often. If you're as dedicated as you should be when you're analyzing your charts and whatever that comprises, you probably know that they probably look the same same today as they did yesterday, barring any dramatic move. You're probably not going to change too much of what's going on in your decisions. But we're not going to be talking about charts tonight. We're going to be talking about the preparation in general, the things that you should know, not only about your stock in general as far as your what does the company do, some company specifics, but also other things like what should you know about your brokerage account? What should you know about the way that your stock or your index settles? All these things. So we're going to talk about what you should know prior to the market open. Then we're going to go through and manage the position, and then after the trading day is done, we're going to review some of the procedures that traders should cover on the market's close. And a lot of these things are very mundane. So very few times, after about the first couple of weeks, you're probably not going to do these things every single day in the same capacity. You're probably going to go out, create an Excel spreadsheet to go ahead and actually streamline the process for you. When I started out on the trading floor, I started out as a clerk. And the clerk's job was basically to do whatever the traders wanted the clerk to do, which was usually get lunch for them. But one of my jobs was to monitor and to do all these things that we're going to do ourselves. It was my job to do them for another trader who basically didn't need to be bothered with the minutia anymore and had bigger decisions to make. So my job was to make sure that everything was organized and delivered to the trader. When I came in, just to let you know how long, and that was back in 1997, when I came in, what I was given was a set of Excel spreadsheets that were handed down for generation after generation of clerks. And it was my job to try to make sense of them and to continue to use them as past clerks had used them. Now, what I want you to do is to understand these things that we've covered over the past 11 webinar sessions, and to go ahead and make your own Excel spreadsheets rather than rely on someone handing them down to you, because they're going to help you with the understanding. It would have been great if someone had actually sat me down and actually walked me through all this stuff and then showed me the guided me through creating my own personalized Excel spreadsheet. But, of course, that's not in the job description. So let's go ahead and actually go through what it takes to do things prior to the market open, and then we're going to look at a position, and then we're going to go ahead and look at some of the things that we want to review as the market closes. So as far as your preparation prior to the market open, let's go through a couple of steps. And number one here, I have check your trades. Okay. Very few people in the beginning have enough trades so that they don't remember what they did the day before. Okay, but check your trades. You have positions in place, and you have trades that you've placed during the day. At the end of the day, what you see on your broker's screen should line up during the day, at the close, and then the next morning on the open. And sometimes, I just want to make sure somebody asked. Okay, good. Just wanted to make sure the audio was working. When you're looking at these situations, when you're looking at your trades, sometimes something may happen between one day and the next, and so you have to make sure that your trades line up. And B, and very importantly, checking your trades allows you to develop your trade memory. If you do this every day, it allows you to go out and actually understand what's going on between what happened during your trades, and allows you to remember them during the day so that you can get up and look away from your screen for a while and go do other things. As far as making sure that things line up, there are very few reasons as to why things may be different one night than they are the following morning. And one of the reasons is, for some reason, one of your positions got recorded in somebody else's account by mistake. I don't know how many of you have ever had, if you've been trading a while, have ever had just this random position show up in your account that's not yours, and you've actually had to call your broker, and they said, you know what, we apologize. apologize. That's not yours, and we'll get it back in the proper account. You usually notice it because it's a trade that lost money for whoever actually did it. But the point is you notice it and you realize it doesn't belong. Maybe it's a stock that you don't trade. For whatever reason, the broker mistyped the account number that trade was supposed to be in, and so the next morning something was done in strange fashion. So the other reason for this is if you've ever been assigned early, or you've taken an early exercise of a position, then your position will have changed dramatically from the close to the open the next day, and you need to make sure that your exercises went through, or you need to make sure that you understand that you have been assigned and that you now need to take the next and proper step. So this is why you check your trade. Do not assume that the position you go to sleep with at night is the same position that's going to wake you up in the morning. Okay? It doesn't necessarily work out that way, and you have to understand why things work the way they do. So check your trades before the market opens to make sure that it's the same thing you remember from the night before, and if there are changes, to make sure that you can explain why these changes are there, and if you cannot, pick up the phone, call your broker, and get an explanation before the market opens and starts moving around and there's nothing you can do about it. So it's really important to check your trades, and I put that in as number one. Number two, check your commissions and fees. Make sure you're getting charged proper commissions. If you go to, for most brokers out there, they have commission structures for everybody. Seriously, there are brokers out there, and the ones that we like, the ones that we don't like, they all have hundreds, if not thousands, of commission structures. Everybody gets a deal. Everybody gets something. Everybody's special and unique, just like everybody else. And so everybody gets their own. Everybody gets their own commission schedule. You've got to make sure that yours lines up, and you got to make sure that whatever you agreed to, you're still getting, because sometimes these fees can change. The other thing, if you get assigned, or if you exercise a position, there are certain fees associated with that do not come out as a standard commission. And you need to know that. You need to know what your fees. What is the exercise/assignment fee? Is it per contract? Is it a fixed amount? And if it's a fixed amount, how do you deal with a position in which you have multiple contracts? If you're going to get assigned, and each time you get assigned, you're going to get charged $15 for the assignment. What happens if you own 100 contracts and you get assigned on one a day for the next 100 days? These are the kind of things you want to make sure that you talk to your broker about. And when you start to see that you're getting assigned, which a lot of times can happen if you're short some deep in the money puts, you're going to be periodically assigned on one thing from one day to the next. You need to be able to talk to your broker and work something out there, or find a solution to that. So check your commissions and fees. Third, check your P&L. Did you make or lose what you expected to make or lose? And this usually is not an issue when traders lose money. I expected to lose $8,000. I lost $8,000. Everything's fine. I expected to lose $8,000. I lost $9,000. That's close enough. Here's where it becomes a problem. I expected to lose $5,000, and I ended up making $6,000. This is where it becomes a problem, because typically a retail trader will not complain about a position in which they've made money, even if, according to their best recollection, they should have lost money. And it's important because you may have been able to make the money because of an error by the broker. In other words, that money's not really yours, and in a couple of weeks from now, when they get around to fixing the mistake and they pull the money out of your account and they have an explanation for it, you may find that you actually needed that money for something else, and it might really ruin your day. So make sure that if something doesn't line up, pick up the phone, call the broker, get it cleared up before the trading day or the trading week makes things worse. Number 4, check for news on your stocks. And we're not asking you to become a fundamental analyst or a fundamental trader or anything of the sort. All we're doing is we're asking you to make sure that you check the news. Are there earnings today? Does the stock go ex-dividend today? Did the stock pre-release? Was there a special announcement? Was there something that's germane to your industry that you need to keep in mind, such that there are no surprises once the trading day starts? Is there a reason to believe that today, as opposed to yesterday, volatility is going to be a lot higher than it was yesterday? Not because the stock moved, but because some piece of news came out that said that the stock might make a move one way or the other very soon. These are the kind of things you just don't want to wake up one day and see that things have changed and you can't explain why. Just like you want to explain a big stock move, you want some sort of an explanation for it, you also want to be able to explain a big move in volatility so that you can decide how you want to go ahead and trade around that event. Number 5, calculate an expected move on your stocks. Okay, every day. You should not be trading. It's not like you're trading thousands of them. So calculate an expected move based on the at-the-money options so that you can get an idea of how the market thinks that your stock is going to behave. And this is really, this is something that for those of you that can't be near your screens, have your broker set up to give you text messages when you get beyond a certain level. And so when you calculate the daily expected moves, you can say, I don't need to be bothered today unless my stock moves beyond these levels. And the expected moves give you a guide for that. Now, if you have a stock that ends up doubling in value overnight because of some unknown news, guess what? The next day, your expected move is probably going to be close to double. So you've got to, if you have a big change, don't just assume that the expected move from the day before is going to equal the expected move every day. Make sure you do your due diligence and factor in and calculate the expected move every chance you get. Okay? Know where the at-the-money straddle is trading. And this goes back to really knowing your options. Keep a journal of how the at-the-money straddle changes, because at-the-money may not be the same level every day, but the at-the-money straddle, you may have a stock that's trading around $220, and the 220 straddle, if it's trading for at a certain level, and all of a sudden the stock starts drifting towards 230, well, now the at-the-money straddle is at 230. But if you look back at when it was at 220, how much more is the 230 straddle than what the 220 straddle was? Has it kept pace? Has time decay started to eat away at it? Is it holding its value? And if you think about it, if you're trading in the last month and a half of a stock, and a straddle is holding its value from one day to the next for a week or a week and a half, the straddle is holding its value, that means time decay is not being taken out. And what that means is the volatility is being pumped up to keep the straddle at a certain level, which means the marketplace is expecting something. And these are things that we've got to be able to keep in mind. And again, the reason I do this is so that you understand, and as it also says with step number 5, know your implied volatility levels. Okay? If you look at Apple, okay, and you think you think to yourself, okay, I'm trading Apple, and Apple's trading around right now Apple's trading around $203, almost $204. Okay, and if I were to look at the March options, okay, the 200s and the 210s, you're looking at about a 28 to 29 volatility. Okay, so you can say, well, Apple's a 29 volatility stock, and you feel comfortable with that. And every day you go ahead and you look at your options, and Apple's 29 vol. So all of a sudden, if you start seeing the volatility start creeping up, you have to ask yourself, why is the volatility creeping up? What's going on in the marketplace? Why is this being sustained? Why are they not allowing the time decay to run its course in Apple, at least temporarily? Okay, so these are some of the things that you have to ask yourself. And hence, you have to keep not only track of your implied volatility levels, but also the price of the at-the-money straddle. If I look at the March options right now on Apple, I want to go ahead and, if I look at the at-the-money straddle, you're looking at about, in March, you're looking at losing about 22 cents a day on about a $14 straddle. Okay? On the other hand, if I were to go ahead and look at the February options, it tells a little bit of a different story. The February options are going to tell me that I'm going to lose about 45, 46 cents on a $5 straddle. So on a $5.50 straddle. So you can see that all of a sudden, if I'm losing, call it 50 cents on a $5 straddle, if I'm losing 10% of my value every day, and for some reason that stops or that changes dramatically, I should know why. So we want to make sure, just to be able to paint the story, we want to be able to know where the at-the-money straddle is trading and independently where the implied volatility levels are. Make sure, and again, keeping track of just the implied volatility does not necessarily tell you that just because implied volatility levels are stable, it doesn't necessarily tell you where the at-the-money straddle is. Because remember that you have to take into account what you're trying to answer here is whether the straddle is if there's a mechanism out there that's keeping your straddle from decaying as it naturally would. That's what you're looking for. You're looking for something. You know that your straddle's got to be worth less tomorrow than it is today, all else equal. Okay, you know that that's the case. We're looking for a situation in which, okay, I expect my straddle to be worth 50 cents less tomorrow. What if it's not? Okay, what if it's worth the same? So, and why is that? Is it because the stock has moved? Is it, is it a delta thing, or is it a vega thing? Is it the volatility has been pumped up into the options to keep them from keep the time decay from moving away from you? So again, what it does is it helps you see why things are changing, so that when it's time for you to fix something, you don't go out and fix the thing that's not broken. Okay? You want to know the value of your nearest out-of-the-money call and put spreads. And this is something that really comes down from the floor trading standpoint. And it's something that if you get into a habit of knowing this, it'll help you out tremendously. What is the nearest out-of-the-money call and put spreads? Because if you're going to go ahead and actually adjust a position, butterfly it off, or turning into a condor, or roll a butterfly one way or the other, or roll, even something as trivial as a covered call. If you're going to roll your call to the next strike, it makes sense to know where is that call spread trading. So know where your first out-of-the-money call spread and put spread are trading, because it'll give you an idea of how much you might have to allocate in funds for your adjustments. Okay, you're going to eventually get to the point where you're adjusting your positions, and a lot of these things require either the implementation of a call spread or a put spread, or they require rolling a single option. And as everyone knows, rolling an option is nothing more than a vertical spread. If you're going to roll an option out over time, it also makes sense to know your first month time spreads. Where's the time spread trading? Where's the at-the-money time spread trading? And obviously, by now you understand that the call time spread and the put time spread differ by the value of the roll. So it doesn't really make you don't have to go out there and calculate both. You should have an idea where is that time spread trading in case I need to go and roll out in time. Anything beyond that you can do on your own time if you think you're getting close to expiration and you might have to go ahead and roll out to the next month and further out in strikes. Maybe at that point you want to go ahead and learn those spreads. But typically on any given day, you should know your first out-of-the-money call spread, your first out-of-the-money put spread, and you should know your at-the-money time spread while that's going on. So, for example, if you have Apple trading around 203, you should know that in February the 210-220 call spread's trading for about 30 cents, and you should know that the 200 and 195 put spread is trading for about 70 cents. Okay, so you should know, okay, my out-of-the-money put spread's about 70 cents. It's a 5-point spread. My out-of-the-money call spread is about 30 cents. It's a 10-point spread. And you should know these things. You should know that it's going to cost you 30 cents to roll if you're short the 210 strike, it's going to cost you about 30 cents to roll from the 210s to the 220s. If you're short the 200 put, it's going to cost you about 70 cents to roll down to the 195s. These are things you should know. You should have a pretty good idea, and they don't take that long, and we're looking at about 30 minutes of time to get all this stuff done prior to the open of the day. So we're just going through the professional prep work. Step number 7, know your interest rates, dividends, and short stock rebate levels. Okay? They are going to determine a lot of things. Your dividends. Why should you know your dividends? Early exercise. If you're long call options, you should know whether they're an exercise or not. If you're short call options, you should know if they're going to be assigned and what steps you might be able to take in the remainder of your position to be able to anticipate the early exercise accordingly. So that's the reason for the dividends. As far as the interest rates are a tricky one, but I understand that in this current environment, your 1% interest rates are not going to be much of a, they're not going to be much they're not going to move anything dramatically. However, as interest rates rise, for whatever reason, be it inflationary, be it just because interest rates are going higher, you need to know what your interest rates are, because the higher your interest rates, the higher the propensity of put early exercise. And that being the case, if you have a position where you're short 100 puts and you start getting assigned 3 at a time from now till expiration, just in early exercise fees, that could prove expensive. So these are the kind of things that you need to keep in mind, and why you need to know your interest rates and dividends at this point. You should also know your short stock rebate levels. When you sell stock short, how much are you getting in interest from your short stock position? Okay? This is important for 2 reasons. If you ever have short stock, you need to know how much it's going to benefit you to have the cash collecting interest in your account from now until expiration for any given position, for any given short stock position. The other reason, as you saw last week, is because if you're used to getting 0.5%, let's call it 0.5% in a short stock rebate, and all of a sudden you find that you're no longer getting any short stock rebate, you may have to ask whether your stock is entering the realm of becoming hard to borrow. And if that's the case, you might be subject to some sort of buy-in risk, in which case you want to make sure that you don't end up with that. You don't end up with the buy-in risk, and therefore you might want to go ahead and adjust your position. Along those lines, you want to know whether your stock is hard to borrow, because suppose you don't have a short stock position, but suppose instead you have a long stock position. If you have a long stock position and you find that your stock is going hard to borrow, there's probably an opportunity for you to place reversals for credits. And that's just for a long stockholder on a stock that goes hard to borrow. That's about as close to free money as you can get. Okay, you trade in your real stock for the synthetic, and the worst case scenario is you buy the stock at a lower level than where you initially had it. So again, you want to know whether your stock's going hard to borrow. Along those lines, know your stocks. Okay, know what sectors your stocks are in, because if something goes ahead and actually and it impacts your sector, it's probably going to impact your stock. If if something impacts the personal computer business, it's going to impact Apple. Okay, if all of a sudden we find out that nobody wants to, suppose there's a big program to get computers out to every kid in the world. Okay, well, that's going to benefit. On some level, somebody's clearly got enough funding to get a computer to every kid in this universe. that's going to mean that everybody's going to be either one of two things. Either they're going to be donating them, or they're going to be able to give some old computers and clear out some inventories at a good price. Whatever it may be, if something is a sector-wide phenomenon, you want to know if it includes your stocks. B, you want to know what business your stock is in. Okay? And I know that there's a lot made in in retail education that, you know what, I trade all these stocks and I don't even know what they do. You know what? You don't trade those stocks. Okay? And I'll tell you, you need to know what things do. You don't need to be, you don't need to be a whiz kid, and you don't need to know every single number, and you don't need to be reading balance sheets, and you don't need to be reading balance sheets and income statements and cash flow statements and any of that stuff. But you do need to know what your stock does. Otherwise, why are you trading this thing? Okay, you need to know what impacts them. C, impact numbers. This is a little bit tricky, in part because we haven't covered it here. Okay, but let me just give you a little bit of insight into impact numbers. Impact numbers are basically the numbers that determine what kind of an impact. It's kind of like the delta of it's kind of like the delta, the change in the delta of an index, kind of relative to your stock. It's the change in the index value based on the change in your stock. And what this means is, for example, suppose that if your stock moves $1, it happens to affect the Dow Jones by 20 points. Okay, so you need to know that because if your stock moves up $1, and that's going to move the Dow Jones 20 points because that's the way it's represented in the index, then that's the impact that your stock has on the Dow. And here's what can happen. Suppose your stock's not open for trading yet, but you notice that the index is up 100 points. Well, if that's the case, you can kind of backtrack and say, well, I guess my stock should be trading about $5 higher if there's an extra 100 points in the Dow today. These are just some of the things that you want to make sure that you can look them up on the internet. You can look them up and do a search on Google and say, what's the impact number of Apple? What's the impact of IBM on the Dow? What's the impact of IBM on the S&P 500? So you want to know those things. Earnings and dividends. Okay, again, you want to know those fundamental factors. When are earnings coming out? Because you know what's going to happen in that month? Your volatilities are going to be higher than they are in a typical month. And you need to know that that's not necessarily an opportunity. That's just the way the options are going to trade up until expiration. Okay, so if you wake up and go, wow, yesterday the stock was trading at a 40 volatility, and today the front month options are trading at a 60 volatility, why is March trading higher than February? Well, if it's an earnings month, that might be your answer, and you just have to be able to understand that versus having there be some other piece of news that you need to be looking for. So understanding when are earnings, understanding that sometimes do companies have a tendency to pre-release or not. These are the kind of things that you want to keep in mind. The dividends. Again, as I stated earlier, has your company changed its dividend structure recently? Is there a special dividend coming out in which you might actually have the strikes adjusted? Okay, this happened in MGM a while back where they issued, I think it was an $8 dividend in MGM, and what they ended up doing was people said, well, if the stock's at $20 and there's an $8 dividend, then everybody knows the stock's going to be trading at $12. So what did a lot of people do? They thought they'd be really clever, and they bought the 20 strike puts, thinking when the stock goes to $12, they'll be worth $8 minimum. What ended up happening is when you have a special dividend, they actually changed the strikes so that as soon as it happened, they adjusted the strikes down to say the 20 strike is now the 12th strike. So all these people that bought these puts ended up making absolutely nothing on their trade. Basically, the market remained unchanged. They just moved the strikes around to make sure that the dividend did not interfere with the integrity of the markets. So those are the things that you need to be able to keep in mind. Number 9, check the S&P Futures Levels. This is before the market opens, and although the stocks are not trading, the S&P Futures are open. They're open for trading, and we need to make sure that we're aware of where the market is expected to open this morning, because if it looks like the market's going to remain unchanged, then maybe you don't have to sit around for the market open. But if you think that the futures are going to rise or if the futures are trading higher prior to the open and they're trading dramatically higher, maybe you need to sit around, look at your positions, have an idea of where your stocks might be trading, and start to look for making adjustments. So the S&P futures give you a little bit of an indication as to what the market is looking to do on the open on any given day, and you should know this information prior to the market open. Number 10, and I know I've mentioned this before, but I want to mention it as an isolated event, have an idea of where your stock's implied volatility level currently sits. Okay, and what I mean by this is there is implied volatility, and there's also, and what I mean by looking at where the level currently sits, compare it to previous levels. Where was the implied volatility last week, last month, last year? What is the historical, statistical volatility of a stock, and where are we in relation to that? And I bring that up because I know a lot of people are thinking, well, does that mean that there's an opportunity if the implied volatility is higher than the stock's volatility, than the statistical volatility? Not necessarily. Because implied volatility tells you what the market's doing moving forward. Statistical volatility tells you what the stock did looking back in time. So basically there's a thick line that determines, there's a thick line that stands in between present and past. And one of these volatilities helps explain the present, helps explain the future, and one of them helps explain the past. And you can't really assume that one is necessarily going to lead the other. But you need to have an idea. Okay, you know what? Our volatility levels are at all-time lows. They may stay here for the next 20 years, but they're at all-time lows. And so if we're going to be trading strategies such as iron condors and the such, we might want to be really careful about how we structure these trades, given that volatility levels are at all-time lows. And given the fact that we're probably not going to go much lower, and therefore it's going to take us a while to make this little bit of money that we're trying to make off of this iron condor position. So we might want to look at something else to trade. So these are the things that we want to do prior to the market open. Okay, and again, good thing that these things are recorded and you'll get the copy of the slides so that you'll be able to see the kind of things that you want. And not everybody's going to do this, okay? Oh my goodness, I'm not going to do half that stuff. I'm screwed. No, you know what? Not everybody's going to do this. But there are some things that, depending on the level of trader that you've achieved, these are some of the things you want to incorporate into the prep work. Okay? All right. With that said, let's go to the position management, and here's the position, okay? 1,150 options in the spiders, all in the front month, all about to expire. And we've taken the liberty of actually, we're going to look at this as if it's, Thursday of expiration week. And the reason we're going to do that is we're going to try to make all of these decisions on one given day. And what I'm trying to do is give you an idea of how you can dissect this mess. Okay? Here's some February 98 calls, 103 calls, 106 calls, 108 calls, 109s, 98 puts, 99 puts, 100s, 101, 104, and they all have different positions. We have 200 of these. We're short 33 of these. We're long 52 of these. All the way down the line. One day, you may actually end up with a pile of options that looks like this. And you need to be able to dissect it. You need to be able to make sense out of it. So you're going to be able to see this on your broker statement as you look at the option chains. What I've done is, first of all, I want to take you through and look at the Greeks. And if you look at them live, as I looked at them live, basically this position has no delta, and it's costing about $2,000 a day, and we're long Vega. Okay, so clearly we're net long options here. We can see that if the position goes up 10%, our delta is really, really big, which means the gamma has really started to work for us. But notice that after a while, the gamma just ends up basically going down to nothing. And really, we're at some point, if the stock goes up 10%, from $110 to about $121, we're basically playing, instead of being a delta neutral, we're going to be playing for $20,000 a point. And so basically, we're going to be really, really, really bullish at that point. If the stock drops 10% and we end up at about $99, our delta is going to be, we're going to be playing close to $7,000 a point, and we're still going to be short gamma. So we're going to be short gamma, and as you can see from the approximations, the theta doesn't quite line up. But that means that there's something in a rounding error here. But the important thing to realize is that we're still playing for $7,000 a point. And if you look at the graph, this is what our position looks like. Okay, you can see that basically we're bullish on this position. But for the most part, there's very little. If you think about the stock being at 108 to 110, there's very little that's going on in this particular area. And so therefore, as we start approaching expiration, and we realize that we're pretty flat in our position for quite a large range, then now we start to think about what it means to take this position off. What's the best way to take this position off? And of course, we could look at the position, and we could just buy back what we originally sold and sell out what we originally bought. So as we look at these particular trades, and we start thinking about what to do, and there are all the positions. Okay? That's everything that we're going to do. The positions are going to be, these things right here. The strike is going to be in the center, and then I'm going to have the bid-ask on either side and the deltas on either side. So as you can see, we're getting fairly close to expiration, and these particular options, we have risk here. It may not seem like it, but we do have risk. And the last thing we ever want to do is to leave a position on where we have risk knowing that we could have taken it off. I know that things that are worthless are probably going to expire worthless, but we have to make a concerted effort to understand our positions and do the things that are necessary to dissect these positions properly. So let's go through, and as we look at this position, we want to figure out where should we start. And step number one, what I like to do is I like to start with positions that can no longer do much for you. And that means the deep in the money options and the deep out of the money options. Those are the places where we like to target because those are the easiest to address. Okay? So what I'm going to do is I'm going to start with these two. I'm going to start with the deep 200 of a long 98 strike call. Right here. I'm long 200 of those. And the 200 of the long 113 strike puts. Okay? Let's assume that we're going to expire at the end of the day today. Okay? And let's assume that expiration is later on today. Well, with the stock at 109, with the spiders at 109, a move to 113 represents a 40-point move in the SPX. Chances are, if we haven't gotten a 40-point move yet in the day, we're probably not going to get one. So, and again, we're just thinking ahead a little bit, but we have to be realistic. We have a position in which, it's very unlikely that we're going to get either to 113 or above and to 98 or below. So what we're going to do is we would like to address these positions first. Clearly, the 113 puts are basically 100 delta puts. And one of the things that I want to make sure that we understand before we move forward, I put the position deltas in these columns to show you something. suppose there's 1 day left till expiration, and you look at these deltas and you see that these are these puts have a -10 delta. These have a -6 delta, -4 delta, -3. The Black-Scholes model, and most of the variations of the Black-Scholes model that you'll see as retail traders, and oftentimes even as professionals. The Black-Scholes model is basically going to show you the delta from the beginning of the day. Basically, it's going to say the model says that with 1 day left till expiration, the delta should be this much. The fact of the matter is, as you progress through your trading day, that delta, based on second-order derivatives, the change in delta over the change in time, is something significant. And what's going to happen is, as we get closer to expiration, more and more and more of these out-of-the-money options, whether they're puts or whether they're calls, more and more of them are going to end up with a delta of 0. Okay, so what you're going to find is that the deltas of all these options, these little deltas, as the trading day progresses, those deltas are not really there. And so they are what we have called in the past phantom deltas. Okay? On the last day of expiration, as time continues to decay, what you find is that these deltas don't really exist anymore. Those options are probably 0 delta options. Just as their in-the-money counterparts are pretty much 100 delta options. So we have to keep that in mind and decide how are we going to deal with these situations. So in this particular case, the 113 puts are showing a 95 delta. Sometime after the first hour or so in the day, those are you can consider those 100 delta puts. They're probably going to settle, and since you own 200 of them, you're going to end up basically short 20,000 shares of stock. On the other hand, you're long the 98 calls, which means you're going to end up long 20,000 shares. So notice here that as we look at the position, these options, the 100 delta options, they behave very much like stock, and hence it's not worth selling them. It's not worth closing them out. In fact, you're better off, you're better off on these 100 delta options. Suppose you only had one side of them. Let's go back to these. And suppose you only had the deep-in-the-money calls. You did not own the deep-in-the-money puts. Okay? If you own the deep-in-the-money calls, with the stock around 108.94, 108.95, there's no reason to sell these things at 10.89. In fact, the lowest you should consider selling these things is 10.94. However, the market is 10.89, 10.99. There's no good reason to sell these things down to 10.89 and sell them 5 cents below real value. That absolutely does not make sense. So what should you do instead? If you only had these, then you would pre-sell the stock, because what you would end up doing is, since you own those calls, if you pre-sell 20,000 shares of stock, then what's going to happen at expiration is these deep-in-the-money calls are going to end up turning into long 20,000 shares, and your position's going to cancel out. However, okay, so this is what's going to happen most of the time, and absolutely most of the time. Once in a blue moon, what's going to happen is, if the stock happens to drop below 98 in the few hours that remain prior to the close because the market fell out of bed, your short stock is going to make money for you, and your 200 calls you may not want to exercise. And what have you basically done? If you sell stock against these call options, you basically own 200 of these 98 puts for free. Okay? And they're probably not going to be worth anything, much like a lottery ticket, but if somebody gives you a free lottery ticket, you take it. Okay? It didn't cost you anything to take it. The same thing happens on the other side. You have the long 200 of the 113 puts. And the idea here is they're going to turn into 20,000 shares of short stock. So you would pre-buy 20,000 shares of stock in order to offset anything that might happen there. If the stock does go above 113, your long stock is going to basically make money for you, and your your 113 puts will just go out worthless if the stock rises above 113. So in essence, what you would have is a free 113 strike call. Now, notice what I've just said. In the first part, I said you would pre-sell 20,000 shares. On the second part, with the puts, I said you would pre-buy 20,000 shares. So clearly, as we've pointed out, in this particular case, the 20,000 shares that we would need for the 20,000 shares that we would get from the long calls are going to cancel out the 20,000 shares that we're going to get from the 200 long puts. And what we're left with, because we're going to have the stock to cancel the other side out, we're basically left with a fairly worthless synthetic out-of-the-money strangle. Okay, if we go back and look at the position, we are left with the 98-113 strangle synthetically, because these are basically 100 delta options. We basically own 200 of those strangles. We just happen to have that in our position. So while, as it says in the middle here, while we're typically better off trading stock against each respective options and taking the free calls or puts that result, in this particular case, since we have offsetting in the money positions, we just let them be, because we already have the free corresponding option. Okay, for the deep in the money calls, because we own the deep in the money puts, synthetically we own the out of the money puts. And for the deep in the money puts, because we own the deep in the money calls, we synthetically own the out of the money ones. So we don't have to do anything with this particular position. So what we've done is we acknowledge that they're just going to cancel each other out at expiration, but I've taken them out of the position because they're basically 20,000 long and 20,000 short deltas. So from a delta standpoint, they cancel each other out. And at expiration, it's not going to make a difference to our position. We're going to buy stock at 98. We're going to sell it out at 113. And that's just the way the things are going to develop. So we're not going to, that position, whether we own it or not, until the stock moves beyond those levels, we're not going to really pay much attention to it. That position right there is pretty much inert. So what we're going to do, what we've done is we've taken them out of the position. They're still there. We haven't closed them out, but we understand that they don't add anything to the risk profile. So now that we've taken those out, let's move on to the next step. Okay. And as we start figuring out what to attack, as I said, we want to look at the things that are deep in the money or deep out of the money and see how we can address them. We want to start deep in and deep out and work our way to the middle. So, and remember, we have time to do this. This is not all happening in 5 seconds. This happens over the course of a day. In fact, prior to the market opening, you've probably had a chance to stare at these positions for a while. So we have a couple of things that I want to look at. We're short 200 of the 101 puts, and we are long 100 of the 100 puts, and we are short 100 of the 99 puts. So what do we do with that position? Okay, and as we move forward, we have 2 short positions. Okay, we're short options at the 101 strike. We're short 200 of those. And we're short options at the 99 strike. We're short 100 of those. So the first thing that we might consider doing is buying those back. Oh my goodness, we're short those options. Let's buy them back. Before we do that, let's remember the 99 strike is covered by the 100 strike. Right? Even though we're short the 99 puts, we're covered because we're long the 100 puts. Okay? With the index at 109, it's highly unlikely that we're going to drop below 100, much less below 99. But if we drop below 99, in the spread I have in red, the 199 put spread, we're covered. Okay? Right now, this spread here is going to expire worthless. If the stock makes a dramatic move to 99, this particular spread is going to make us an extra $1 that we didn't think we would make. So we are covered on the short 99 puts. buy the long 100 puts. So we're going to leave that alone. We're going to pretend it doesn't even exist. However, and the 101 strike is a different story. The 101 strike is also very unlikely to be reached with the index at 109, but we're not covered. And every single person here has either a personal story or has had someone share a story with them where they said, you know what, that option, I was short a bunch of these options, and they were so far out of the money that I didn't even bother to close them. I wish I had closed out those deep out of the money options because then they came back to hurt me. This is one of those cases. So what are we going to do? We're going to buy back these 200 short puts. And as you look at the bid and ask price, 3 cents at 4 cents, understandably, some brokers, once an option gets below 5 cents, they no longer charge you a commission. And if that's the case, you may want to go ahead and take advantage. Now that these options are below 5 cents, of putting in an order to buy back those 200 options to close. Okay, so that's something that you want to make sure that you keep in mind. We should look to buy back the 101 strike because there's no reason for us to be short those 200 puts uncovered. So what we're going to do is if we buy those back, then we would take them out of our position. So if we buy them back, the risk and the exposure is gone. Let's go concentrate on what else we have here. And now we're going to address the long 199 put spread that we have here. It's worthless, okay? These deltas are basically zero. This spread is going to expire worthless. If something happens, if nothing happens, this thing's going to expire worthless. If something happens, it's going to be worth $1. So right now, let's assume it's going to expire worthless. The point is, it poses no threat to our position. Okay, with the ETF, the spiders at 109, this spread is not in danger of contributing to our overall risk. Okay, all that can happen is that this worthless spread gains some value. So what we're going to do is we're going to remove it from the position because it does not pose any threat. Okay, can it change? Yes, it can accidentally give us money, but it's not posing a threat to us. So let's just pretend that it's not there. Okay, and let's move on to the next thing. But what this allows us to do is to now clean up our position a bit. And as you start to see, we are now, we're now starting to get to the meat of the trade. The next thing that I want to go ahead and consider is the 98 strike puts. I'm long 52 worthless puts. Okay? And this is something where, again, as you can see, what I'm doing is I'm taking out the positions that I've either bought back or sold out or no longer pose a threat. The long puts that I have here, it would be great. If I'm long 52 of those puts, it would be great if the stock went down below 98, but you know what? It's probably not going to happen. So rather than check on my lottery tickets and check on the numbers every hour, how about if I just pretend I don't own that ticket and give myself some peace of mind? So what I'm going to do is I'm going to go ahead and remove these 52 long puts from the position. Note, again, as I've said before, we are not selling them, okay? I'm not selling these things out. I'm just removing them from the position, just from a mental standpoint. I'm pretending they're not there so that we can see where the risk in our position truly lies, okay? And now we're left with all these options. And I ask you, okay, as you look at the remaining position, do we have some boxes here? Okay? Do we have some boxes in this position? And the answer is yes. We actually have, if you look at it, we're long the 103 strike calls. We're short the 103 strike puts. We're short the 106 strike calls. And we're long the 106 strike puts. So we've got a long box position in there. And we should be able to do something with that. And it's great that we're able to recognize this because it's going to save us a ton of money if we recognize that we have boxes in that, A, we have the boxes. B, with the stock at 109, there's no there's no threat of pin risk, okay? We have 30, okay, because that's the lowest number here. The lowest of all of them is 30. We have 30 embedded boxes in this position, 30 of the 103, 106 boxes. The index is at 109, which means that these boxes, relatively speaking, these boxes that are at the 103, 106 strike are relatively harmless. Now, unless the index drops to 106 and we're subject to pin risk with the few hours that remain, chances are these boxes are going to settle to $3, and therefore they don't pose a threat to our position. So what we might consider here is actually, even though we're not going to do anything with them, we can remove 30 options apiece from each of these four levels, so that we can reduce our position down to the bare essentials. And so note that we're not closing them out. We're not doing anything. We're just looking at our position and eliminating 30 boxes, because from a risk standpoint, the boxes don't do anything to our position. So if we're trying to figure out how to manage the risk, one of the first things we have to do is figure out where the risk is not. And then once we figure out that something has no risk, then we ignore that and move to where there is risk. So if we remove 30 boxes, now we're left with this kind of a position. Okay? As we look at this position, let's now take a look at the long call spreads. We have 8 of the 103, 106 call spreads. Okay? And if you really think about it, this is a 3-point spread, and again, deep in the money. Okay, it's only 8 contracts based on our position size. It's 8 contracts with the index at 109. This spread is in all likelihood going to settle to stock. These 103 calls are going to settle. They're going to go ahead and settle to stock, long stock at 103. These 106 calls are going to settle to short stock at 106, and we're going to get our $3 per spread. All right. Now, we also, what can happen if we go back a little bit? If we go back before we look at the 109 put, this is a long spread. The 103, 106 call spread. We own 8 of them. Okay? If we own 8 of these spreads, it's a $3 wide spread, and if we look at it as $300 a contract as far as spread, and we own 8 of them, that's $2,400 that we could lose if the stock were to go below 103. So, just to make you feel better, here's what we can propose, and there are a lot of different ways to handle this one. But how about this? Since we own 22 of the 109 puts, let's just say that if the stock rises, if the stock drops below these levels, if the stock drops below 106, below 103, if we were to take 8 of these long 109 puts and say those 8 puts are going to cover these 8 short calls over here, these 8 long calls over here, then maybe, we can go ahead and say, okay, as the stock drops and these long calls become lower and lower in value, our puts are going to increase, and they're going to go ahead and offset that. On the other hand, as the stock rises, these puts are going to increase in value. This spread is eventually going to move to a big level. It's going to move deep in the money. These puts, we're going to get hurt on these puts. We have to decide whether we're willing to take the risk on those 8 puts and whether we're willing to lose that dollar. And that's your decision to make. But one of the things that we could do for now is, if you wanted to, you could remove 8 of the 22 puts that you have at the 109 strike and say they're going to be responsible for hedging this spread that I expect to go out in the money. And what are you going to do? You're going to watch this position nonetheless. You're going to watch this 109 strike, because that's where you are. You're right at the money, so you're going to watch it a little more carefully. But for right now, let's remove it from the position, okay? And if we do, now all of a sudden this is what we've got left. We're short the 108, 109 call spread 33 times, and we've got 14 embedded 109, 103 put spreads, okay? So one of the things we could do is, given that we've got this put spread, we could look at the possibility of closing out 14 of these and then 14 of these put spreads and then figuring out what to do with these other options. The problem with that comes in that you start getting too cute for your own good. The fact of the matter is, you own, other than the 8 options, that remember, you still own the other 8 options. You're just claiming to use them as a hedge for the 103, 106 call spread that you have. Okay, but in addition to those, you have another 14 options that are costing you, if the stock stays around here, about 98 cents a piece, 98, 97 cents a piece. And so if you look at that, you basically have about $1,300 of decay if the stock stays right here. You're not going to make as much on that on your 74 options at 6 cents. Okay, so we risk about 7 cents of time value per option at the 103 strike versus, even though these options are 97 cents at 98 cents, the time value is only about 92 cents on the 109 strike. In this particular case, we simply sell out the 109 puts, buy back the 103 puts, and close out that portion of the position. And I have a little asterisk that's sitting there. And the reason I have an asterisk is, as it says at the bottom, if your broker does not charge you a commission to close out a trade that's worth 5 cents or less, these things are 6 cents at 7. And as you get closer and closer to expiring, and as we get closer and closer to the end of the day, these options are going to decay to the point where you may be able to buy them back for 5 cents or less. 74 options at 5 cents or less may be an extra $74 in commissions that you don't have to pay. In other words, you may save those $74, and that's if you're getting a dollar contract. If you're paying more than that, your savings might even be greater. So, if you see these options, they're 6 cents at 7 cents. What happens if you wait 30 minutes and all of a sudden these things are now 4 cents at 5 cents and you're able to buy them back for 5 cents? If you're able to sweat the position, this is one of those judgment calls where you might be able to say, these things are so far out of the money, I may just sweat the position and wait until they're a lot cheaper and buy them back at a point in which I don't have to pay commissions. So I wanted to bring that up. Lastly, okay, and based on this particular example, one of the questions that I've gotten in the past is, what happens if I wait enough for these things to decay such that the 104 or the 105 puts are trading for 5 cents? Could I buy these out instead? Could I buy the 105 puts 74 times and basically turn this into a 105, 103 spread? You could, because buying the 105 or the 104 puts would be preferable. If you could buy those for 5 cents, it would be preferable to buying the 103 puts for 5 cents. You would have closed out the risk and given yourself an extra couple of dollars in case the stock does go down there. The one difference is that if you do that, you are going to pay, even if you buy those options for 3 or 4 cents, if you buy them for less than 5 cents at some point, you're still going to pay a commission, because remember, if you buy the 103 puts, you're buying them back to close. If you buy the 104 or the 105 puts, even though you're closing the risk in your 103 puts, you're still buying these particular options to open, and therefore you don't get the commission break. So keep that in mind as you start deciding how you're going to handle the position management from that standpoint. So in this case, we would simply sell out the 109 puts and buy back the 103 puts, 14 by 74. If you wait until the 103 puts are 5 cents or less, you may consider doing this as a separate transaction. Okay, and the reason is you want to make sure that you get credit and are not charged a commission for buying these back if you buy them for 5 cents or less. Okay, depending on the broker you use, again. All right? Now, that leaves us with a short call spread, a bearish position, and it's worth about 62 cents. Now, as we like to say, by the time you get to this point, it's a bearish position. It's worth about 62 cents. If the stock stays right here, it's going to be worth about 94, 95 cents. Okay? And so we would lose somewhere between 32 and 33 cents. Somewhere just over $1,000, almost $1,100 if we stay here. It's if you have reason to believe that the stock is not going to go higher or that it's going to drop in the last few hours because you happen to be that good at predicting, knock yourself out. Stay in the trade, live it out, wait for the index to drop below 108. If you're like the rest of us that can't really predict, at this point you're going to assume you're going to buy this thing back for about 62 cents. Okay? Why wait around to lose the additional 33 cents? At that point, just close out the trade. That's a very simple one. One of the things that I want to make sure that I bring up is do not get cute. Okay? Once you get to this last trade, it's a short call spread. Buy it back. A lot of people start thinking, well, would I go ahead and look at boxing it off by selling the 108, 109 put spread? No. And the reason is very simple. We're right at the money. Okay? And what's going to happen if we box it off is, first of all, the options. These are 153 at 154. And these are 91 cents at 92 cents. The markets are already 1 cent wide. Going to the box is not going to give you tighter markets than the ones that you see. Second of all, this would only lead to pin risk. Because now all of a sudden you have, with the index near 109, with the ETF near 109, you have a decision to make with the 109 strike. So you may have to pay more later on to exit this position, and you're not really saving anything by boxing off the position. So don't get cute. Once you get to this final position, go back to basics. There's a reason you learned how to buy what you sold and sell what you bought initially, so that you're able to make things, so that you're able to make, so that you're able to perform the basics because there's a time and a place to perform the basics. So again, just because you learn to use the box, it doesn't mean that you're going to use the box every single day. Once you've got all this stuff done, the position itself is closed out. And once the position is closed out, now we have to start asking yourself, what are some of the things that we want to do after the market is closed? And so let's go ahead and follow in on that. And I hope you guys have liked the way that we've walked through this position and the way that we've recognized a lot of things. The reason that I want to go ahead and look at these things is, once the market's, I hope I want to do the same kind of exercise on Thursday, and I'll pick another position to go ahead and pick apart on Thursday, hopefully with with 1 day left till expiration. I think we'll find some nice stuff in there. What do we do after the market closes? First of all, keep a journal of your trades. The reason is your memory's not as good as you think it is. And in the weekly webinars, the ones that we do on Mondays, every Monday, we actually we touched on this on the session on trading psychology. Your memory fails you more than you think. There was an experiment that was done when the Twin Towers in New York collapsed due to the September 11th of 2001 events. Believe it or not, during all the mayhem, there was a group of psychiatrists or psychologists or somebody out there that was doing this study, and I don't know what they were waiting for, but they went out there and did this study, and they grabbed a lot of people, and they said, we're going to keep track of you, but we want to know what happened today. Where were you? What did you do? What were you thinking? Who did you call first? All these things, and these people start responding And it was a pretty traumatic event. And I think, for anyone that was there remembers exactly the magnitude of that event, especially if you were in a major public place. These people were just, saying, well, I was here, and this is the first thing I tried to do. This is what else I did. I remember every single step. They went back to these people, I think it was 5 years later. They found that the vast majority of the people, when they were asked the same questions, gave a completely different story. And it just goes to show that over time, your memory is not what it used to be. It doesn't remember things. You cannot even trust your own memory. So keep a journal of your trades because your memory is not as good as you think it is. You may think you have positions on that you actually don't. You may have been thinking about putting some trade on, and then you don't. So keep a journal of your trades. 2, do an expected P&L calculation for the next day. Why? Because it'll give you some peace of mind in what remains of your position. This is every night after the market closes. Okay, what's my P&L swing looking like tomorrow? Just so that I know what I'm faced with on average between now and the next day. 3, check for any aftermarket activity in your stocks. The markets close. People go home. That does not necessarily mean, just because the market closes, it doesn't mean that events around the world stop occurring and affecting the market. So what may happen a lot of the time is after the market closes, there might be a piece of news that may be directly impacting your stock. And you want to make sure that you understand that so that you're able to prepare for the adjustments you're going to make when the market opens. And finally, for those of you that trade the OEX or trade any equities, if you have a certain interest or dividend situations, you want to make sure that if you have options that you should exercise, then you want to make sure that you submit any early exercise forms, or just call up your broker, or if you can do it online and say, I want to exercise these options early. If it's expiration and you have an option that expired in the money, but then due to certain market events you find out that those options are actually going to expire out of the money, what you want to make sure that you do is that if these options are based on the stock settlement, if you're going to get assigned, or if those options are going to be exercised on your behalf because you're long them, but then you see, for example, suppose you own calls in Apple. Apple settles at 208. So you're long the 205 calls. You're going to get assigned. They're going to be automatically exercised. You're going to own stock at 205. All of a sudden, the market closes, and you realize that something bad happened in Apple, and it's now trading after market at 180. Well, clearly, you don't want those 205 calls to be exercised. So what do? You send a contrary exercise notice and say, I do not want those long options exercised. I know they expired 1 cent in the money, but I do not want to own stock at 200 or 205 if it's only trading at 180. So you send a contrary exercise notice. By the same token, if the stock closed at 208 and you're long the 210 calls, and now all of a sudden the stock goes, after the market closes, the 210 calls expire worthless. Suppose you've got 100 of them. Well, now all of a sudden you find that the iPad, the new thing that Apple just came up with, is the greatest thing in the world, and and everybody's buying one, and there's like people from other planets coming in to buy them, and you realize the stock is going to open at 275 the next day. Well, now you send in, again, a contrary exercise notice that says, based on where the stock closed, I was not going to exercise my 210. My 210 calls would not have been exercised automatically. I am consciously exercising those options. So, again, on the particular day when it's necessary, you want to make sure that you take care of your early exercise situations, and you want to make sure that you put in the necessary contrary exercise forms if applicable. I bring this up because I want to make sure everybody understands the concepts and the nuances of whatever product you're trading, whether it's a stock or an index, American or European, cash settled or underlying settled. You have to understand these things and decide when and if you're going to exercise an option. I just got a question today on my discussion board, specifically talking about somebody that had a very unpleasant experience on OEX early exercise. Somebody got assigned on the short portion of a butterfly that they thought was deep in the money, and there was nothing to be done with it. Well, clearly, somebody was long those options, and based on the move after the market, they got assigned on the puts. So, again, these are the things that you need to make sure that you keep in mind, so that these things don't happen to you, so that you can at least anticipate. At least if you're not going to exercise anything, make sure that you're not in danger of getting assigned, or if you are, make sure that you know what to do and how to act accordingly. As far as I'll answer this one particular question, how much time do you have to submit a contrary exercise? When I was on the trading floor, I had a couple of hours, and the average person you have at least half an hour typically, but it absolutely varies by broker, and B, varies within brokers, okay? If you have a nice big account, Mr. So-and-so, you're going to be able to do whatever you want. You're going to be able to come in maybe an hour, 2 hours later. If you have a small account where you're trading one contract, you might want to talk to your broker, and you might want to get it in a little bit quicker. So these, I remember having about 2.5 hours when I was on the trading floor. You still have a respectable amount of time, but it's something that I don't want to give any specifics, because not only does it vary by broker, it varies within a particular broker, depending on who they give preference to. They'll be willing to stay late for the big players. They're not willing to stay late for everybody. So you want to make sure that you call up and ask how long you have in order to make those changes. Okay? One of the things that I wanted to do before we wrapped up for today is I wanted to go ahead and review the trading example from 2 weeks ago. And as you remember, we were looking at the OEX, and SPX 1.5 spread, and we looked at this particular trade for a 40-cent credit. And that's just because of the way that the market fell and the way that things ended up lining up in the particular indexes. Now, I also, this is one of those trades that, as I said before, we brought it up because we had a little bit of extra time in the course, and we wanted you to become aware of some of the things that we're able to do. And this is a trade that, as I stated before, is going to have a large amount of exposure in the practicals course that's coming up. It's going to have a lot of exposure there, but since we had some extra time during this course, we went ahead and wanted to give you the introduction and wanted to give you something to follow. This particular trade was the purchase of the 470 put spread in the OEX twice, and the sale of the 1030, 1020 put spread in the SPX. And by looking at the numbers, we were able to go ahead and actually place this thing for a 40-cent credit. Now, I will say this. If this were February, then we would probably consider writing this thing out for the remaining amount of time that's there. However, going up to March with this particular position, because they're March options, anything can happen. The addition of Berkshire Hathaway poking its nose in the major markets and in the major indexes might make things a little bit unusual. It's amazing to me that Berkshire Hathaway is finally there's the rumors that it's going to, it's now in the SPX. The rumors are that it's coming out in the Dow any day now or any minute, and who knows, but it may upset the balance of things. I think it's about time that the people that control the markets have decided that Warren Buffett does a better job than they do. And, he's and as I like to joke, he's the only guy, I think, that made more money off of Goldman Sachs than the people at Goldman Sachs. And it's pretty remarkable what he's been able to do, especially over the past few years. But then again, if you've got $100 billion, what could possibly make you panic? He went out there and made some very good decisions over the past couple of years. So as we look at the spread right now, the thing that was able to be placed for a 40-cent credit, if you look at the fair value of it, is trading for even money, 70 cents on the 475, 470 put spread, and $1.40 on the 1030, 1020 put spread in the SPX. So we could look at this thing and decide to trade it for even money, and basically get out of this thing and take the $800, put it on for even money, and move forward. And the idea here is the markets may rally, and they may move forward, but and at the end of the day, it might have been smart to just ride it out. But the idea here is, why tie up the margin any more than you have to if you can exit the trade for even money, number one. And number two, there's a lot that can be said for, and there's a lot of uncertainty coming up with the index rebalance, things that we may see from now on moving forward. So on a particular trade like this, if you can get out for even money with this much time and free up the margin and be able to use it for something else, then why not? So that's something that you would probably want to consider from the standpoint of trade management. So that is the first of two sessions on position management. On Thursday, we're going to go ahead and examine another position and consider some of the necessary post-market work and some of the pre-market work that traders do. So you should have gained a sound understanding of the daily prep work prior to the market open, after the market closes, and you should have gotten a decent understanding of how to close the position as expiration approaches. And as you start to see the pieces, the 1,150 options that we put out there, really no more than a couple hundred of those at most, in fact, probably less than a couple hundred of those options really made a difference when it really came down to it. At the end of the day, you're always looking at what cancels what out, and you saw the two biggest positions, the deep in the money calls and the deep in the money puts, ended up canceling each other out. And a lot of these intimidating positions, if you just take a little bit of time to think them through, they actually end up canceling out as you continue through your trades. So we wanted to show you that no matter how big a position is, take the time. Okay, we took an hour during this webinar to pick apart that position. Take your time with the position, understand how to, not to panic, and do the prep work prior to the opening of the day, do the prep work at the end of the trading day, and things will go a lot smoother as we move forward. So with that said, Thursday represents our last session. What we're going to do is to give you a write-up and a recap of this particular position management within 24 hours after Thursday's session is done. Thursday's session is probably going to be a little bit more involved. I want to make sure that everybody understands how to pick apart positions and how to do things. You'll already be a little bit seasoned based on what we've done today. So we're going to make it a little bit more challenging to make sure that everybody's aware of the things that you need to look forward to as we continue to our last session. So I hope you've been able to see the comparisons in how you would now attack a big position with the knowledge that you have versus how you might have attacked it prior to taking this course. And a lot of this, I hope some of this seemed fairly elementary when we got out to it, because a lot of it comes from the preparation that we've been able to do over these 11 sessions. And as you can see, and as we will make note of it in the write-up, there's a lot of money that would have been saved and hence earned simply by recognizing when you don't have to exit something just because you entered it. And then whether it's commissions, whether it's bid-ask spread, we're talking a lot of money that can be saved by learning to close out your positions correctly. So hopefully you've been able to see the value in what we've done over these 11 classes. And I hope that you're going to look forward to what we're going to do on Thursday. So with that said, we're going to continue with the session at that point, continue to review. And for everybody involved today, I want to say good morning, good afternoon, and good night, depending on where you are, and I'll see you in a couple of days. Thank you so much.